Good morning, good afternoon, good evening, traders, wherever you are in the world. My name is Victor, and this is my first video. I'm actually a software developer and also a trader, and I actually intend to improve the lives of traders by giving you guys quality tools that's going to allow you to make profits while trading and without going through so much hassle. Now, in today's video, I'm going to be talking about grid trading right off the back. And if you've never heard about grid trading, stay tuned and I'll be explaining what it means and how you can make use of it to make money. Now, a lot of people kick against grid trading, but just stick with me and I'm going to just explain what I know and how you can apply it. Now, grid trading is basically when you trade between intervals. Now, what do I mean by intervals? For example, you're buying Euro USD at $1, and then once you buy it, Euro USD did not go in profit and it actually went in a loss. And then you actually buy it again. And then once it goes in more losses, you buy it again. Now, this sounds very horrible because most people do not calculate their risk and do not know how much they are risking. And some people actually apply martingale, which means as you're buying lower, you're actually increasing the lot sizes when you're doing that. Now, I actually support this, but the tool that we're going to be using in trading is going to allow us to be able to calculate the risk when we are buying with grids and even martingale. Okay, so stick with me, guys. We said grid trading is when you're trading within intervals, maybe buying within intervals. That is buying when the market dips or selling when the market skyrockets to the upside. So what is the benefit and why do I advocate for this? Now, imagine you're trying to buy a market and you just go in a very, very huge lot size. For example, 20 lot size on Euro USD. Now, if that market just goes on a loss, you're losing $500 and you're probably setting a very, very tight stop loss. Now, I'm against tight stop losses and I'm also against using a huge loss size from the beginning. Everything has to do with risk management. So you have to be very, very risk managed. Now, the tool I'm going to be introducing to you, I'm just going to show you guys a video from what I did today, just at the end of the video. The tool we're going to be using today is going to allow you to calculate your lot sizes, know how much you're risking on a trade, and also know how much you'll be gaining if the trade goes in profit. Now, when you're talking about grid trading, I forgot the point, so I'm going to cut this part out and I'm just going to start again. Yeah, now when you're talking about grid trading, you do not need to know the direction the market is going. Although I'm going to be showing you guys the best scenario that you can make money almost every day, given a good market setup. Since we are not going to be catching tight stop losses, we don't need to stress ourselves about getting a razor thin stop loss. Okay, guys, let me hold this. Let me hold this camera well. I'm actually filming on my phone. Okay, let me clear my face. I'll cut this part out. Now, when you're recording, when you are, okay, cut this part out. Now, when you're trading using grid trading, you don't necessarily need to know the direction the market is going to be heading into, as you can make profits regardless. Now, for example, the market was going to buy, instead of going in with a big lot size, you're actually going to go in with layered lot sizes, which allows you to capture the move of the market in the direction the market is later going to go. Now, if the market is very, very bullish and you are doing this grid trading to the upside, because we are going to be following the trend and we're going to be risk managed, because if you don't do these two things, you're actually going to end up blowing your account. So the first thing is we are following the trend. So wherever the market is going, if the market is going up, we're going to try to catch the trend to the upside. If the market is going to be going down, we're going to try to catch the trend to the downside. So what makes this good, just like the example of what I did today, is that when you take a buy and the market is going to the upside, if the market retraces, in most times, 9 out of 10 times, it's actually going to continue going in the direction which it was intended to go. So this allows you to capture more profits most of the time than losses. And if you consistently do this, you're going to notice that you're able to pull out more profits in the market most times than trying to get a big loss sizing and putting tight stop loss. So we're going to use a big stop loss. layer it with grid trading and also martingale, which means we're going to increase the lot size as it goes down, but we're going to know how much you're risking, so that when that market goes down, even if it retraces to the upside a little bit, you're going to notice that you're already in profit and you're able to withdraw from the markets. Now, this is the style that most traders use, that they are able to consistently pull out profits from the market and keep making money, and you guys are just going to look at it as if they are actually doing something special, in which they're actually not doing anything special. They're just following the rules and following the grid trading style. Now, if you're interested in learning exactly how we do this grid trading and make profits, just like today, I took this particular trade which ended up in a profit, which I was trying to illustrate the video. Then get subscribed to this channel, like this video, and leave a comment on what you think about grid trading style. Do you think it's too dangerous, or what do you think about it? Just let me know, and I'll be seeing you guys in the next video. Stay blessed and stay strong.